Hi everyone, and welcome to the Sustainable Finance Research Seminar this week. We have Abraham Lioui from EDHEC Business School here with us. He will present Chasing the ESG Factor. And before we start, just to remind you of the usual rules, please mute yourself. However, if you have a clarifying question in between, feel free to ask. And yeah, for longer questions, please wait till the end and we will record the session. So without further introduction, I would like to hand over to Abraham. It's a pleasure to have you here and we're looking forward to your presentation and the floor is yours.
Okay, thank you very much, Linda, for the opportunity to present the paper. I'm so happy to be part of this prestigious list, so grateful for this opportunity. So this paper, Chasing the ESG Factor, is a joint paper with Andrea Tarelli, who luckily is sitting in the beautiful city of Milano. And I will start, first of all, by saying a few words about the basic issue we are after. So people that are following this seminar and more generally people following the sustainability story know that there has been a lot of buzz in the recent years around sustainability in general, ESG in particular, climate risk also, all these topics which are related to companies in particular, because this is what we are interested in this paper, companies doing things beyond just profit maximizing, okay? And then people usually ask the question, is it possible that a firm, by following targets which are not compatible a priori with profit maximizing, still can deliver what they are supposed to deliver to shareholders, that is value. To put things in the simple words, the issue we are after is to try to answer the question which is, do high ESG rated firms outperform low ESG rated firms? Let me remind you, ESG is for environmental, social, and governance. Okay, these are all the extra financial dimensions that stakeholders, broadly speaking, care about and are trying to scrutinize the firm and to see how well they are doing on these dimensions. Okay, so the issue we're after is, do responsible firms outperform irresponsible firms? Before I dive into the contribution of the paper, I would like to give the contribution of the paper in a nutshell. So the postulat of the paper is that the method used to assess the outperformance or underperformance of responsible firms matter a lot for the message you can convey to the academia and the industry, and can be a source of confusion. This confusion is well established as to the empirical mixed evidence about whether responsible firms outperform irresponsible firms. And what we pretend in this paper is that the method used to address the issue at hand may have some contribution to this confusion. In this paper, we propose a new method to construct a pure ESG factor. What do you mean by pure ESG factor? It's an ESG factor which is not exposed to other firm characteristics which we know are relevant to understand the cross-section of stock returns. For example, we know that the size, the book-to-market ratio, and other characteristics of the firms are important. And what we mean by pure ESG factor, we mean an ESG factor where we are able to shut down all the other characteristics and sort stocks only on the ESG characteristics, which will be the only characteristic which will matter for the factor. The factor is constructed on a monthly basis. This means that you don't need neither backward nor forward information to build the factor. And this is very important because, for example, other factor construction requires market-adjusted returns. For this purpose, you need beta. And if you need betas, you need some past history to measure the beta, which require additional information relative to what, in our construction methodology, we need to construct the factor. Because it is based on a monthly basis, this factor, by construction, it takes into account possible changes in the tests of individuals. When they change, the month or the time period where they change, we are building every month the factor. Hence, automatically, we are going to be impacted by the change into this test. And obviously also, because it is on a monthly basis, if there is some change into the risk aversion and the risk premium required, broadly speaking, in the market by investors, we will also account for it by construction. Our third result is that the method matters a big deal. Okay, when you look at the pattern of the returns or at the patterns of the alpha from the factors extracted from two competitive methods that I'm going to develop shortly, you see that the patterns are completely different. Hence, the method matters. The second result is because we are able to construct the pure ESG factor, we are able to mute all the differences in the database covered by different data vendors. We can build a pure ESG factor per data vendor. Hence, we can compare among data vendors. And what we show is obviously that the disagreement among data vendors has material implications for the measure of the ESG risk premium. Okay, so for the roadmap for this talk, I will start first of all by giving some motivation for this paper and positioning our contribution relative to the ongoing debates in the literature. Few words about the theory behind the factor we are building, the data, the findings, and finally, a few words about the implications of our new factor construction about the confusion, the ESG confusion debate in the literature. So about the motivation, the key question is, should responsible firm outperform irresponsible firm? In other words, what should I expect as an investor when I go for responsible firms, high ESG rated firms? What should I expect in terms of returns or expected returns? Here, many papers have contributed in this literature, but I picked up just one, a recent one, the paper by Pastor Stambo and Taylor. And in this paper, what they say, if some agents in the economy have preference for ESG, but automatically this preference will be factored into the returns. The alpha of the responsible firms will be negative, leading to a lower cost of capital for the responsible firms. Okay, so we should expect green firms to underperform brown firms. Okay, reflecting the lower cost of capital that investors are charging to green firms. Unfortunately, the empirical evidence is much less clear-cut. That is, we have tons of papers, thousands of papers, okay, but there is no consensus. Okay, so we have papers who find a positive relation between ESG rating and returns, and other papers who find negative relation between ESG rating and returns, and others who don't find any relation. Okay, and this mixed empirical evidence is really a puzzle that many people tried to address. The first direction that has been followed to address the puzzle related to the mixed empirical evidence is on a theoretical side. The idea was to say that it is true that in expectation, we should expect responsible firms to generate a lower return relative to irresponsible firms. However, if tests for ESG are time varying, these tests can generate some realized return which offset this negative alpha. Okay, so we have two offsetting effects: preference for ESG, which should generate a negative alpha, hence a lower return, but time varying preferences, which may be at a high level, like in the last 3 years, which can generate a realized positive returns for responsible firms. Okay, negative alpha with positive returns from positive shocks to ESG preferences, they can offset each other, and even more, like Pastor Stambo and Taylor or Zerbib have shown, we can see that the positive effect of the positive shock to preferences can offset the negative alpha predicted by the theory. Okay, this is the first take, the first approach to explain the mixed evidence that we observe in the empirical literature. Another take, which people from Zurich are well placed in this literature, it's about ESG confusion. The idea is, and the first paper to document this, or at least to document this evidence in a rigorous way, is the paper by Burke, Colville, and Rigaudon, where they showed that if you take several data raters, you find very little correlation between the data raters. Worse than that, you can take the same firm which can be ranked first with that one data rater and last in the ranking from another data ranker. Okay, so this confusion around the ESG rating can be at the heart of the mixed evidence that we observe empirically. Now you can ask your question: if I take one data vendor, how is this related to ESG confusion? In fact, a recent paper by the same authors augmented by Pavlova is very interesting, where they show that because of the confusion and the noise around the measure of ESG, they showed that the coefficients from an ordinary least square regression of returns on ESG rating is biased downward. Okay, this may explain why from time to time we find either negative or positive or even no relation between ESG and returns. So our paper go into this direction of trying to understand the mixed empirical evidence as to the relationship between responsibility or ESG rating and returns. And in this paper, we ask the following question. When we look at the overperformance, outperformance, or underperformance of stocks, should we go in a time series approach or in a cross-sectional approach? These are the two competitive methods to construct the ESG factor. And the purpose of this paper is to rigorously compare this method, improve the cross-sectional method, and to show that we can reach a method where what we are measuring is exactly what we want to measure. A few words about the factors, because it's important for the following of my speech. In the time series approach, this is from French. Suppose you think that one characteristic matters for the cross-section of returns, for example, ESG rating. So the way you proceed, you sort stocks according to their ESG rating. And for example, you construct two buckets, okay, above the median and below the median of stocks, above the median in terms of rating and below the median in terms of rating. Then what you do, you evaluate the return of the stocks in each bucket, and this gives you the long leg and the short leg of the ESG factor. The spread between the two is aimed at capturing the spread in the return between responsible and irresponsible firms. So you see, when you use the ESG rating, you use it in an ordinal way. The only purpose of the ESG rating is to rank the stocks. Once you rank the stocks, you cut the sample into responsible versus irresponsible, and then you evaluate the return in each one of the buckets. The second approach is the cross-sectional approach. In the cross-sectional approach, you use the ESG rating in a cardinal way. What does it mean? It means that instead of just using the rating to rank stocks, you use the rating to rank stocks, and the weight of the stocks in the factor is their rating. Okay? The weight of the stocks in the factor is the rating. So you consider the rating as a cardinal variable. Okay? So when a stock has a rating of 0.2 and another stock has a rating of 0.4, the 0.4 stock will have a position in the factor which is 2 times that of the 0.2. This is not what happens in the time series approach. Okay, so these are the two approaches in the literature, and what we want to do in this paper is to compare in a rigorous way the two approaches, okay, and see what are the implications for the measurement of the ESG-related risk premium. Our contribution is twofold. First, we theoretically suggest a new method to construct, as I said, a pure ESG factor, okay? And the empirical contribution is to use this new method and to say a few words about its implication as to the materiality of the disagreement across data vendors. Okay? And we show that the disagreement, ESG disagreement, has material implications for the assessment of the ESG risk premium. Okay. Alors, theory. I will say a few words about the theory because it's important to see all the steps we follow, and I will also relate what we do to existing literature and say exactly where is our contribution relative to the literature. The starting point of our paper is not the paper of Pastor Stambo and Taylor, where they've developed a model and got an expression for the ESG factor. I will tell shortly why we prefer to focus on the Fama-Macbeth methodology. The Fama-Macbeth methodology purpose is to construct cross-sectional factors. Okay, so a few reminders about this methodology, and then I'll show you our contribution. In Fama-Macbeth, usually what you do is the following. You stand in a given month. At the beginning of the month, you know the characteristic that you care about. In our case, ESG rating. Okay? So then what you do, you run a predictive regression of the returns of the stocks in the cross-section on their ESG rating. So the regression you see here is a cross-sectional regression that you run month by month. Okay? One precision which will be important for the reminder, in general, the ESG or the characteristic is demeaned. Okay? It is demeaned, and as such, it allows for a long-short portfolio interpretation of the findings. So when you run this cross-sectional regression, you obtain an estimate of the slope. The estimate from OLS from mean squared errors of the slope is given by this expression. Okay? Here the bold is for a vector. ESG bold is the vector of ESG rating of the stocks in the cross-section. Okay? And RT is the return of the stocks in the cross-section. Okay? So this is a well-known result. This is the Fama-Macbeth interpretation of the slope in this regression, and lambda 1, as you can see, can be interpreted as a portfolio where the weights of the portfolio are this one. Because the sum of the weights of the portfolio are 0, remember, we have demeaned the characteristic, hence the portfolio which return is the slope lambda 1 is a long-short portfolio. Okay? So if you repeat this every month, eh bien, every month you have the ESG rating. Every month you construct the portfolio, you compute the return on this portfolio, and this gives you the premium of this portfolio. And this premium is exactly the ESG premium because it is the return on the long leg of the portfolio are responsible firms with high ESG rating, and the short leg of the portfolio are irresponsible firms or firms with the lowest ranking in the ESG universe. Okay? By the way, this is roughly also the ESG factor put forward in the theory paper of Pastor Stambo and Taylor with one key difference. This is why we prefer to lean on Fama-Macbeth than on Pastor Stambo and Taylor. In Pastor Stambo and Taylor, instead of using the return, they use the return in excess, market-adjusted return. They use a market-adjusted return. That is, they clear the return of the stocks from their beta exposure to the market. Why we are happy not to do it this way? Because when you use returns which are net of the market return, you need to estimate the beta. Hence, you need to estimate the beta over some period, 24 months or 36 months. Given the dynamic nature of ESG, we don't want to have to use past data because we know everything is changing dynamically. So even assuming maybe the beta for the stocks constant, we know that it's not constant for the stocks according to other characteristics, but maybe also according to the ESG. Okay, so the only thing we need is each month the rating information plus the return. With these two information, we can build the portfolio, we generate the ESG premium. Okay, so this is Fama-Macbeth. Of course, there is no contribution on our part so far. What's the problem that we see with this portfolio, which has been used, by the way, by several people in the literature on top of the time series approach to measure the ESG premium? And this portfolio has several problems. The first problem is that this portfolio has a rating of 1. Okay, so whether your rating is between 0 and 100 or between minus 50 and 50, or minus 0.5 and 0.5, whatever the scale of your rating will always have a rating, your portfolio, sorry, will always have a rating of 1, which means that when you compare this portfolio to the time series portfolio, in fact, you did never guarantee that they have the same rating. Why? Because the cross-sectional factor has a rating of 1, while you don't know what's the time series, the ESG rating of the time series portfolio. So you are not comparing two portfolios which have the same rating. And this can generate a difference in the returns of the two portfolios. Hence, studies which use the cross-sectional factor or studies which use the time series factor will reach different conclusions as to the existence or not of an ESG premium. So, first problem of this portfolio, it has an ESG rating of 1. Second, very problematic property of this portfolio, it is not scale invariant. As you can see, if you multiply all the ESG ratings by a factor alpha, eh bien, you divide the weights by a factor alpha, and hence you divide the return of the ESG factor by a factor alpha. Okay, it is not ESG, it is not scale invariant. The way in the literature they try to cope with this scale invariance is in corporate finance or even in Pharma French 2020, what they do, they set up the variance of the ratings to be equal to 1. Okay, they set up the variance to be equal to 1. And Pastor Stambo and Taylor, what they decided to do is to set up the variance of the portfolio, the variance of the return of the portfolio to be equal to the variance of the time series factor in the sample period they had. Okay, we believe that these normalizations, while they fit the purpose, they may be somehow arbitrary, or at least we need to find a good reason why we should follow this kind of regularization. What we propose in this paper is to adjust the Pharma Macbeth portfolio by a factor rho at each time t minus 1. That's the very simple adjustment we suggest to do to the Pharma Macbeth portfolio. Okay? Now, what's the purpose of this adjustment? But it has fantastic implications. First implication, it turns out that rho will be the rating of the cross-sectional factor. It will not longer be 1 as usual, but now it will be rho. The second consequence of scaling the portfolio from Pharma Macbeth with rho is that your portfolio will become scale invariant relative to the ESG rating. As you can see, if you multiply all the ESG rating by alpha, then the target also will be multiplied by alpha. Alpha times alpha is alpha squared. Here you have also alpha squared. It cancels out. Your portfolio becomes scale invariant. So when you set up rho, you set up the rating of the portfolio, and also you immunize your portfolio to the scale of the ESG rating. Finally, you are not suffering any look ahead or look back bias. You don't need to measure beta, hence you don't need past data, and you don't need to use the variance of the time series factor over the sample to scale, hence there is no look ahead bias. So these are the beautiful properties of this portfolio. And for socially responsible investors, what you see is that it has very interesting implications. One is that as a socially responsible investor, you can set up a target. You can say, I want to target the 19% percentile of stocks in ESG, 75%, whatever you want. If you just set up the target, we can build a portfolio that reach this target. Another beautiful thing of this portfolio is that to reach this target, you don't need to screen stocks. Okay? You can keep just all the stocks. You just set up the target and you can reach the target by just setting the target, not by excluding stocks from your portfolio. In fact, whatever the target, you can show that the ex-ante Sharpe ratio of the ex-ante Sharpe ratio of the portfolios, whatever the ESG target, is the same. Okay, so these are all the advantages for people following socially responsible investing when following this new methodology to construct the ESG factor. Now, remember, what we are saying is that there are two methods to build the ESG factor. First method is the time series approach. Second method is the cross-sectional approach. By using our suggested scaling of the pharma Macbeth portfolio, you can see that you can reach very nice sound comparison between the factors constructed using the time series approach and the factors constructed with the cross-sectional approach. Okay? One word before we move to that, you can ask yourself, what's the economic foundation of scaling the portfolio with this parameter rho? In fact, what you can show is that the portfolio we are suggesting will obtain if you were to run the pharma Macbeth methodology with this regression. Usually you regress just on the characteristic. What we suggest is to regress on the characteristics scaled by the targeted rating. As such, in fact, what becomes important now is not the rating per se of the stock, but the rating of the stock relative to the targeted rating. And now you understand why the scale is not important, because what matters is the relative ranking of the stocks to the target and not just the relative rating of the stocks in the cross-section. Now, we can compare in a sound way the time series factors and the cross-sectional factors. The return on the cross-sectional factor is this one, while the return on the time series factors is this one. MC is a vector of the market capitalization of the stocks in the cross-section, and W is a weighting matrix which guarantees that you have a long-short portfolio, long small stocks, and short big stocks. Okay, as usual for the size anomaly, but here we are not after the size anomaly. We are after the ESG anomaly. Hence, this portfolio is long high ESG stock and short low ESG stocks. But instead of weighting the ESG stocks with their ESG rating, we are weighting the stocks with their market cap as usual. If this is the return of the two portfolios, what you can show is that the expected return spread between the two factors is given by this very simple expression. Okay? In particular, ex ante, the return spread is not zero. However, if you set the rating of the cross-sectional factor to be equal to the rating of the time series factors, what you obtain is that the expected return spread between the two factors is just zero. Okay, so you can shut down the spread between the two factors, and indeed, the two factors, well, there is a caveat which I prefer not to enter in this presentation, but if they have the same expected return, they don't have the same variance. In other words, they don't have the same norm in terms of portfolio, and we know that ex post, this can matter. But if we look at the first order importance, impact of the spread in the rating between the two factors, time series and cross-section, and we focus on the expected return spread between the two portfolios, by setting the rating of the cross-sectional factor equal to the rating of the time series factor, we kill this first order difference between the two factors. Now, so far, I didn't control for the other characteristics which we know are important. In the time series factors, it's almost impossible to control for all the characteristics. Why? Because then you have to sort, to double, triple sort in a sequential, independent. It's almost impossible to control for all the characteristics in the time series factors. In the cross-sectional factors, it's trivial. You just augment the predictive regression you use by the characteristics. Here, we added just one characteristic, but you can add as much characteristics as you want. You obtain a cross-sectional factor, which where the features which were appearing before without the characteristics are still there, and hence, for example, the ESG rating of the factor is still rho. Okay, you didn't change this finding. The characteristic of the factor is zero, very important. So if you control for the size, eh bien, the size characteristic of your cross-sectional factor is zero. The value characteristic will be zero, etc., which means that the only characteristics on which the factor is loading is just the one you wanted, that is ESG. This is what we mean by pure ESG factor. Okay, pure ESG factor meaning that we have mute all the other characteristics that are relevant for the cross-section of stock regions. So to sum up, here what we propose is a new way to construct the ESG factor. This way has several advantages relative, for example, either to the time series approach or to the cross-sectional approach as applied in the literature or put forward from a theoretical standpoint by some authors recently. Okay, the factor we propose, you control the rating of the factor, and also the exposure of the factor to other characteristics are nil. By the way, we don't need the variance standardization that is most often used in corporate finance or even in asset pricing when people construct a cross-sectional factor. Voila, this is for the theory. Now, I move to the empirical findings. For the data, I'm not going to spend too much time because I guess most of you are familiar with the data. We are using data from two data vendors, but 3 data sets. We're using Asset 4 and KLD as well as IVA from MSCI. Okay. For each data vendor, we rank the stocks into the database of the data vendor. Okay, we don't look for a cross section. Okay, sorry, for common stocks in both data vendors. We would like to construct one ESG factor per data vendor. Okay, that's what we wanted to do in this paper, to assess the materiality of ESG disagreement. For other data, standard and written data and accounting data from CompuStat. The findings. So the first evidence I would like to show you is about predictability. Remember that the starting point of the Farmer-Market methodology is to run a predictive regression. So, of course, in the first place, you need to document whether predictability is there or not. Here, what I show you is the regression. Each month, you regress the return of the stocks in the cross-section onto the ESG rating. The findings here are for Asset 4, which is our base case. And when I use alternative data vendors, I will let you know. So here we have the predictive regressions for ESG, E, S, and G. Okay, I remind you, we take the returns, we regress on the ratings. What I show you here is the time series of the R-squares. They are there from time to time. They are small, okay? But you may wonder if with this kind of findings, there is any room to go for a cross-sectional factor. The answer is yes, because the literature is aware that when you do regressions, in particular at short horizon predictions, in general, the R-square is very little. It is very small. However, even if it is small, it can have important economic consequences when taken into account. If you are not convinced by this point, let me show you the corresponding R-square of the traditional characteristics. So these are the R-squares of the book to market, the investment, operating profitability, and momentum. As you can see, apart momentum, we do not skyrocket with the R-squares. Hence, we should not blame ESG for a low R-square, because the R-square is very close to the R-square of other characteristics. Okay? Which means also that the time series factors, which just use the characteristic in an ordinal way, is going too far by giving too much credibility to this very low predictability in the short period. Okay, the cross-sectional factor account for this low predictability. Why? Because the portfolio is computed using the constraint that you want the rating to predict the stock returns. The second evidence I would like to show you is, I showed you the R-square, I show you the T-stats from the predictive regressions. Okay, so we don't have, an overwhelming evidence that the T-stat reach in absolute value 10, 20, or 30, but still, it is reasonable. Sometimes it's very high, it's reached as 6 or -8, okay? And as we can see, by the end of the sample period, the T-stat is really there. Hence, we have reasonable level of R-squares, benchmarking with traditional characteristics, as well as reasonable level of T-stat. Now, to be honest, I cannot benchmark too much with traditional characteristics which have substantial T-stat, okay? But still, remember, we have a small sample period and the characteristic ESG got to become public and scrutinized by the people only in the recent years, okay? So all in all, we do believe that compared to traditional characteristics, the ESG characteristics deserve attention from the academy, okay? So this is the first evidence I wanted to show you. The second evidence, remember that in the cross-sectional approach, the rating of the factor is 1. Here, you see the rating of the long and the short leg of the time series factor, okay? And as you can see, we are far from 1. We are not there at all, okay? We are not 1. We are close to 0.1, 0.2, 0.3, but we are not at 1. So when setting the rating of the cross-sectional factor at 1, you can no longer expect the findings with the cross-sectional factor to be comparable to the findings with the time series factor. Okay? Now, empirical evidence as to the returns of these factors. What you see in this table are some summary statistics as well as some economic variables that are used in general to summarize the performance of the factors. So what you have in the column, so in the column in TS are used the returns of the time series factors. In the next two columns are used the returns of the cross-sectional factors where we forced the variance to be equal to 1, and the cross-sectional factors where we forced the ratings of the factor to be equal to the rating of the time series factors. And in the last two columns, you have the same factors here in the cross-section, but where we controlled for additional characteristics, which are size, book to market, investment, profitability, and momentum. Okay? And what I would like, the message from this table from me to you is not that one is outperforming the other. We are lucky, but it's not pervasive in the findings. We are lucky that the cross-sectional time series, cross-sectional factor in the multivariate case, controlling for the time series rating, outperform the time series factors. But what we want you to take from this table is how different are the two factors. For example, if you look at the CAPM beta of the time series factors, it is a minus 0.22 statistically significant, while it is roughly 0 for the cross-sectional factors. This is reassuring because remember, differently from Pastor Stambor and Taylor, we didn't risk adjust our returns, okay? And as a matter of fact, the exposure to the market is still 0. The Fama-French 6-factor alpha of the time series factors is 0, or it's not significant. Why? It is a respectable 0.14% on a monthly basis for the cross-sectional factor. Borderline significant, but it is still there. Most importantly, the time series, the cross-sectional factor with the time series rating has an alpha relative to the time series factors, which is still a respectable 0.15% on a monthly basis. Okay. Finally, using the Sharpe ratio or the certainty equivalent for a power utility with risk aversion gamma equals 5, the cross-sectional factor with the time series rate with the rating set to the time series factor dominate largely the time series factors. Overall, here I show you the findings only for the ESG rating. In the case of the ESG rating, the cross-sectional factor is different from the time series factors. And in our sample period and in our data, the cross-sectional factor do dominate the time series factors. Now, I would like to show you some evidence which put a huge question mark on the spanning test most often followed in the literature to assess whether the ESG factor is there or not. In general, you take the return on the ESG factor, long green, short brown stocks, and then you compute the alpha, 1 factor, 2 factors, whatever you want. Okay? So here you see the cross-sectional factor has an alpha of 0.14, statistically significant. Okay? And the R square is 16%. Not impressive, but in the range of the R square we know. But the most important message of this table is the fallacy of the spanning tests. Why is it a fallacy? But remember, the cross-sectional factor loads on the investment factor of Fama-French, and it loads on the operating profitability factor of our French. But this is a fallacy because we know this factor has zero exposure to these characteristics. So a priori, if using the multi-factor spanning test was here to clean the characteristics, we should see a nice zero everywhere here, which is not the case. Which means that the way in our cross-sectional approach we clear for other characteristics is a strong and sound, economically sound way to clear for characteristics, better than using portfolios of stocks sorted on the characteristics. Okay, don't forget, on the left-hand side of this spanning test and on the right-hand side, these are the same stocks, just repackaged differently. So in general, whatever factor you put on the right, you are lucky if you put a sufficient number of factors on the right, some of them will show up as significant. But this is a pure statistical artifact. Okay, it is just because the factors will be correlated by construction. Okay, so we do not trust the multi-factor, this kind of multi-factor spanning test for the CS factor we are using. Okay, this is why we are going to use an alternative approach to assess the outperformance of green stocks versus brown stocks. The alternative approach consists in trying to extract the alpha from using a Kalman filter where the observation equation is just the CAPM regression, okay? But most importantly, if you believe in the test story that tests are time varying, all the papers showing a constant alpha, they have a problem because the alpha is unlikely to be constant through time if the tests are time varying. Hence, by construction, any rigorous and respectable paper should show the time varying version of the alpha. You can use rolling windows to show how the alpha is time varying, and believe me, you will see a huge time variation in the alpha. Here, we are using a Kalman filter just to smooth out the alpha to be able to get a pattern and to understand what's going on. So here what you have is the time series of the alpha of the time series factors and the cross-sectional factor, where we have control for the rating of the factor to be equal to the rating of the time series factors. Needless to say, a picture is worth 1,000 of words. As you can see, the pattern of the alpha is completely different. While the time series factors will tell you that green stocks outperform by 0.20% on a monthly basis almost all the time, here you see clearly the downward pattern of the alpha as suggested by the cross-sectional factor. Okay. Also, if you look at the cumulative gains from socially responsible investing, they look like they will go to infinity with the time series factors, while with the cross-sectional factor, you reached the maximum, and you should expect in the future, which is exactly the story behind that Pastor and Stambo were telling. In the future, you will see that the returns will go back to the negative alpha predicted by the literature. The beautiful picture here survive if you control for more than the market. So you can tell me, why don't you control also for size, value, etc.? We also control for this, but the picture for the cross-sectional factor doesn't change. Why? The alpha for the time series factor is just dead. Okay, so now if you look at the time series factor, you see that there is no money to make out of responsible investing. This is the mixed evidence. Okay, why? You see that socially responsible investing did deliver big deal in the past, but we already reached the point where the preference for ESG is factored in the prices. Hence, we should expect a negative alpha. Now, the question is what drives the alpha? Very quick answers. So we don't believe in the pharma French factors, etc. So we ran some regressions and we showed that if you take the returns of the cross-sectional factors and you use an indicator of the sentiment, ESG sentiment, we do observe some explanatory power from this sentiment. When you look at the E dimension, for example, you see that the sentiment predicts negative returns, which is consistent with the negative alpha story. But the contemporaneous changes in the sentiment predict a positive returns, which is also consistent with the buzz around ESG generating an increased demand, hence a positive shock on the returns of the stocks. Last but not the least, is ESG confusion material? But now we can answer the question. Why? Because for each data vendor, we can construct a pure ESG factor that is not sensitive to characteristics. Hence, we are muting all the difference in the universe of the different data vendors. Again, one picture is worth thousands of words. So this is the time series of the alpha for the cross-sectional factors from MSCI, IVA, and asset for Refinitiv. And needless to say that the time series of the alpha is completely different depending on which data vendor you are using to build this alpha. We also run some regressions of the factors against each other because we wanted to check if ESG capture E or is highly correlated with the other factors. And as you can see, for example, if you focus on the E factor, for asset 4, but the E factor is roughly the social and the governance factor, while for MSCI, the E factor is a true E factor because it's not correlated with the other two factors. So ESG confusion or ESG disagreement among ESG raters has deep implications for the construction of the ESG factor. Voilà. To conclude this talk, what we were eager after this paper with Andrea was to understand how important is the method in assessing the ESG premium. And the answer is that the method matters big deal. The cross-sectional approach is our preferred approach. Why? Because we can control for the rating and we can mute all the other characteristics. This way we have a pure ESG factor, which on one hand can be used by socially responsible investors to fix a target and to construct the portfolio to reach this target, or by academics to compare the ESG premium implied by different data vendors. I am done. Thank you very much for your attention. And of course, I am open for questions.
Thank you very much, Abraham. It was a really interesting presentation. And as you said, the Q&A session starts now, so feel free to ask questions.
So maybe I'm going to briefly start. Abraham, hi.
Yes. Hi, Marcus.
So I was wondering a little bit, you stressed the fact that this ESG premium might be generated by differences in preference or by a preference. And sometimes I get a little bit confused about whether differences in returns should be caused by preferences or whether it's a risk story. And at some point you presented your results on using sentiment, and you didn't get very specific on how you construct this kind of sentiment factor. And it would be great if you can elaborate a little bit on this difference between preferences and risk. Because if you think, for instance, about the E, you could argue that maybe it's not really preferences. So in Switzerland, we had a law on CO2 emissions, which didn't pass because preferences in Switzerland for saving the climate are obviously not that strong. Maybe there were other reasons. So I doubt quite often this kind of preference story. And on the other hand, you might argue that if you think about the E again, that it can be a risk story because you have governments that will come up with tighter regulations, and therefore it's quite different. So the nature of this impact of ESG on a company's return are so diverse that it's very hard to come up with a coherent story on whether there is a ESG risk premium, but I'll let you.
Okay, thank you very much, Marcus, for this question. So in fact, what happened for ESG is that both are at play, the risk premium story and the preference story. The preference story is called the convenience yield story. What happens is that if you have an economy where agents have preference for ESG on top of the financial performance performance of the stock. In fact, agents look at the stock as a package of two legs, the ESG and the financial return. As such, they will be willing to forgive part of the financial return, which will be offset by the return from the ESG dimension of the stock. In a dynamic model, you can show that this preference will generate a convenience yield. This is exactly the negative alpha of Pastor, Stambo, and Taylor. The risk premium story comes from the fact that the tests are time varying. Think of a model with preference shocks. If you have a model of preference shocks, the preference factor will be priced in the SDF. Hence, it will generate a risk premium. As a consequence, in a fully fledged model, both will be at play. Preference for ESG with time varying preferences will generate the two mechanisms at the same time. First mechanism, a convenience yield. Second mechanism, a risk premium. Which one dominates? It's an empirical question. Okay, so we have another paper with Andrea on dynamic ESG equilibrium, where we show this exactly. Obviously, the big problem so far was that most of the papers were static papers. Obviously, the authors tried to tell the story of the preferences, but the preference story is meaningful only in a dynamic model. You cannot be at 1 plus 1 minus. You need a dynamic model so as the preference shock shows up in the SDF, and then you have both stories that play around at the same time, the risk premium story and the convenience yield story. As to the sentiment, sorry for not being precise, Marcus, but we built a very simple sentiment using Factiva data, and we looked at how many times people, how many times the ESG and ESG related topics, the details are in the paper, of course, ESG and ESG related topic were in the Factiva database of US-based newspapers. Okay, and we built it for every month back to from 91 to 2020. Okay, and then with this sentiment, we have the sentiment that, by the way, we smoothed also because it's too volatile. But we did like Pastor Stambo and Taylor, and we, because of the story of in positive impact on realized return, we wanted to distinguish between the sentiment and the change in the sentiment. Okay, so we didn't push that far this kind of analysis, which could be, by the way, all of the results are robust if you control also for Magnet factors. Okay, but that's what we did in this case. Thank you.
What about a third story there that I've been thinking about is an operational story? For example, if you look at the governance aspects, there have been papers that shown that the companies with better governance outperform, but that actually has nothing to do with preferences or risk premium. It's just better operational control over the company, or better that the investors want to exercise their preferences better, or can exercise their preferences better through the company. And the other one is a lot of the environmental indicators are things that the company should be doing anyway, right? And it's just a renewed focus. Do you think that there's anything to this sort of operational aspect of ESG, or is it all risk premium story along with preferences?
Thank you for this question. It's a long-standing debate whether the G leg or dimension should be considered when you do ESG. Already Ong in his papers from the 2000 and later already discussed the importance of the governance dimension. Worse than that, the governance is the dimension where we were the least able to sign what's going on. It behaves in a weird fashion. So I agree with you. Governance seems not to have that much to do with ESG. Okay, so I'm not sure I am answering the question in the way you expected me to answer it, but what I am saying here is that governance behaves in a weird way. There is no pattern, there is nothing deep, nothing interesting in the governance, and this is why, for example, many authors just leave governance on the side, because, as you say, in any ways the firm has to do it, and the market has already factored for the last 2, 3, 4, 5 decades the governance into the prices. Okay, but again, so we had the ESG like everyone is doing, but we have also the E and the S. As you have seen, for the data vendors, if you look, for example, for the E dimension, you are perfectly right as to asset 4. You see that the G dimension is very strong in the E factor, but not that much when you look at the MSCI, because the G has no explanatory power for the E. Okay, so it's a fair point that you are making. I can tell you for our own research that G is really, really problematic. Okay, again, we are not trying to push this dimension versus the other. Our paper is rather a methodological paper. Okay, so if you trust that G is really ESG, fine. Okay, but by the way, our method can also be used to construct other factors. Okay, because here the G is the G given by the raters, but you can well use proxy for G put forward by the corporate finance literature and construct the factor in the way we did it. The methodology is completely general. We focused on ESG, but it's completely general. Well, I hope it answers a bit your question.
No, it coincides with my idea. When I sketch it out with my co-author, the G doesn't seem to fit in the same thing where people are preferring, right? People are buying an idea with the S, and they're buying an idea with the E. They're possibly buying it in a more efficient company with the E, right? If they reduce emissions, they're reducing costs. So it kind of begs the question, do they even need any focus on E at all? Because if they're optimizing firms, they should be optimizing this anyway. But okay, I'll leave it there. But thank you for your answer.
Thank you.
May I ask a question? It's George here. Hi, Abraham.
Hi.
I have two quick questions. One question is, how about the quality factor? I mean, when you saw the alphas, when you were discussing the behavior of your ESG factor, have you checked how it correlates with the quality factor and what happens if you control for the quality factor? And my second question is, if I understand well, here, as is the case with many other papers, we're talking about realized returns. In the Pastor-Stambau-Taylor first paper, as well as in the sequel of papers they have, now they make the distinction between realized returns and expected returns. So, you know, they have the risk story you mentioned where brown firms outperform green firms, but then if there is a sudden change in the preferences, you may have the picture you find with green firms outperforming brown firms as you do. So just wondering whether your results really, since they're about realized returns, implicitly load on the preference story, and that's why also you have these results when you control for the sentiment. Just some thoughts. Thanks.
Okay, thank you very much, George. So let me start with the quality. It's a pure speculation. We didn't do it, okay? But what I can tell you is that we redid all the analysis, every unique table and result with the factors of Luzang, we get exactly the same results. One. Two, my guess, I don't remember, I haven't touched quality for 1 or 2 years, but my guess is that quality should probably be correlated with the PharmaFrench 6 factors. And given that the PharmaFrench 6 factors are just irrelevant, okay? You see, here is the 1 factor alpha of the ESG factors, and here is the multi-factor alpha. My guess, it's a pure speculation, George. It's not a scientific one because we haven't done it. My guess is that quality will not at all impact the results for the simple reason that, attention, quality as the factor, the long shot factor of Frazini, etc. I'm not saying that the quality characteristic may not impact. It may, okay? It may. So we didn't try it. But as a factor, long short portfolio, I can bet that it will have no impact. Now, as to the realized versus expected story, to be honest, we don't have a model here. It's just an empirical. So if you want, our paper can be seen as a way to measure in a little bit more reliable way the abnormal return of green versus brown. Okay, and what you see here is that I think this picture. Let's look at this picture here, because if I remember well, Pastor-Stambau-Taylor don't control for the characteristic, or they control à la PharmaFrench, not in a characteristic. This is exactly the story of of Pastor Starman and Taylor. What you see is that in the time series factor, you have an alpha. So if we were to run even one OLS regression of the factor on the pharma branch of factors or the CAPM factor, you will find an alpha of 0.22, 0.20. And the story told by Pastor Starman Taylor is that it is 20 basis point, but attention, it doesn't predict that green stocks will outperform in the future. So it generated this in the past. But so here, when you look at the pattern of our alpha, we don't need to call for realized versus expected. Okay, you see that we are already in the negative zone for the alpha. Okay, we already are there. And I think it's a beautiful picture because when you look at the static alpha, which all these factors, models that have been published in RFS or JF or JFE in the last 2 or 3 years, they all use the GRS or whatever constant alpha story. And you see, at least for ESG, a constant alpha story is problematic because of the pattern of the alpha. Now, whether it's a preference story or another story, we let the reader and the audience decide. But what is sure is that taking into account the time variation is crucial. Thank you, Georges.
Good to see you, George.
Good to see you, Marcus.
One question regarding a couple of your last slides on the materiality of the ESG disagreement. So wouldn't it be here better to look at, so ESG can be, or basically the disagreement can happen because of 3 sources, right? You have different scope of the categories, you have a different measurement of the categories and different weights of the categories. So probably it would be best to think about the materiality of ESG disagreement when we only look at the different measurement of the categories. If we can look at categories that each of these firms are really looking at and then see whether they differ in the way they measure the same thing, which relates a little bit to this fun project on non-standard errors, this crowdsourced project, which I found very intriguing. And that would then really be a way to look at the materiality of disagreement, because that's the disagreement in terms of the measurement, which is probably the most important thing.
Okay, thank you very much, Marcus. Sorry if it's not you, but I think you have a paper in this vein, right? Is it you? Or I've read so much papers, but I think I saw a paper on the weights versus stuff. So I fully agree. So we can look at the disaggregated source of disagreement, but honestly, Marcus, if I wanted to do something next after this project, I prefer to go to another direction, which for me, knowing a little bit the data for the last 10 years is super important. Think about it. When you look at the data and when you use KLD data, which were courageous enough in the beginning to give you both strength and concern, what you remark that firms with the highest level of strength are also those with the highest level of concerns. But these firms, they are rated as if they are high strength firms, which is completely illogical. Okay, so what I would like to disentangle and to check, where is the origin of the disagreement? Is it on strength or on concerns? My guess, pure speculation. On the strength, the company is putting tons of money on the table to do marketing that they gave a grant in the companies like crazy try to make everyone aware of what they're doing. For the concerns, not only they don't help the society understand the concerns of their activity, but maybe also they're creating noise. Okay, so this is also a route that I would like to follow. But as to your point, no problem, as long as we can disentangle the characteristic. If you think of measuring the disagreement across the data vendor, like for example, we did it in our paper on ESG uncertainty, Yes, but I'm not sure we can then build the factor, okay? Because it's not one characteristic. So it's really something among data vendors. But if it is a characteristic, if you can downplay a characteristic per dimension that you were invoking, we can easily do it with this methodology.
So I think we are already at the top of the hour. Thank you very much, everyone. And thank you very much, Abraham, for your presentation. Yeah, we will continue in the after seminar talk, but we will stop the recording in a second. But before that, I would like to hand over to Abraham for some closing words.
I want to thank you very, very much for the opportunity to present the paper. I know it's a prestigious seminar series, and I'm so glad I presented to an audience which is really, really a specialist in the field. Thank you very much, and happy for the comments and the feedback I collected. Thank you very much.